Welcome to the Moore Kingston Smith Navigating Challenging Times with Confidence webinar. What we've tried to do is, through the conversations we've been having with our clients over the past few difficult weeks, we've tried to pull together the key topics. And in this session, we're going to cover them. We've drawn on experts in their various fields. So you have me, Tim Stovald. I head up the tax department of Moore Kingston Smith. I'll be covering the measures that the Chancellor has introduced around various tax measures. Richard, who'll be speaking first, is Managing Director of our HR consultancy, and he'll be covering the furloughing rules, which are the ones which have attracted the most queries from our clients. And then closing up for us will be Niall, who heads up our IT department, and he'll share some of his experience of the IT pressures that a business working from many remote locations will have to tackle. So without further ado, I'm going to hand over to Richard, who's going to start the session talking about help for employers.
Thanks very much. Furlough is a relatively new term to us in the UK, whereas actually it's been used for years and years and years in the States. But what we've used in the UK predominantly is layoff. Layoff is a term where we put our employees on a period of time out where their service of employment or their employment is continuous, but they're not going to work over that period of time. It shouldn't be an indefinite period either. It should be for a short period to help the company work its way through its financial difficulties. In March this year, the government coined this word into the UK dictionary. So we started to use furlough, and it's very much linked to the government job retention scheme. So the scheme was set up in March. It's backdated from the 1st of March, and it's predominantly companies that have already laid employees off, or indeed companies that have made people redundant, can access this scheme from that date. It doesn't mean that you can allow your employees to work all of March and then you try and claim from the government job retention scheme after that retrospectively. And I'll go on to that in a minute. You can claim 80% of the salary, and it's effectively for employees who were recruited or who were employed on the 28th of February this year. So if you had a job with your current employer on the 28th of February and you have an annual salary, it's the salary at that date. It's paid through a portal, which is an HMRC portal, which isn't live yet, and that'll be up and running by the end of April. It's not a loan; it is a grant, and therefore you don't have to pay it back. But it is capped at $2,500 per employee, and it's 80% up to $2,500, not 80% of $2,500. Employees are entitled to retain the whole amount, so the company cannot take any additional costs out of the 80%. What employers can claim is the NI contribution that they would make, the employer NI contribution, and they can also claim any other costs such as the pension contribution, which is the statutory minimum. So if you make the 3% payment, you can claim that back. You do have the right to top it up. You can top it up to 100%, and actually the companies that we've been talking to and many of our clients over the last couple of weeks have been talking about being able to top it up to the 100. There are some, it's good to do it. I think there's some reasons why you may not. I think if you're going to furlough half of your employees for 2 months and then you're going to ask the other half to carry on working, the other half have to carry on working and get effectively their normal salary, while the others get to do nothing for that period of time, and they get paid their full salary as well. So there's pros and cons of both. The salary is based on the current salary. It doesn't include overtime or commission. For people that are 0 hours, it's effectively the pro rata salary as of that date. If you can't get a pro rata salary for a whole year period, then you go back as far as you can, or you can use the actual salary as of the 28th of February the year before. The government doesn't pay the employee directly. They're still employees too, so the employees are still paid through the payroll as normal. It's not advisable to change the payroll date if you can avoid it. There really is a contract agreement that you have with your employees. You still have a contractual obligation, and you still have a contractual obligation to pay them on the date that's set in the contract. So the idea is that you would make the payments to the employees, whether it's the 80% or the topped up amount, and then you would seek to reclaim that money back. The employees do still make the pension contribution, and employees do still salary sacrifice if they have a salary sacrifice. Those employees that are on reduced working hours, they effectively can't access the scheme. So if you put somebody on 2 days a week, for example, to help weather you through this storm, that you couldn't furlough the other 3 days. It doesn't work like that. The minimum period of a furlough is 3 weeks, not 3 days. If an employee has more than one job, so they work for you part-time and they work for somebody else part-time, you can still furlough them and they could still carry on their other job. They're both treated as individual, they're individual instances. And you can't simply tell someone they're being furloughed unless in their employment contract it makes reference to it. It's highly unlikely that a UK contract is going to make any reference to the word furlough at all. But what you are looking for is short-time working. So if there is a short-time working clause, then yes, effectively you can say to your employees that they are being furloughed and you're exercising that clause. If they don't have a clause like that, which they probably won't have, then the fact is that you'd have to follow normal consultation in exactly the same way that you would consult with anybody else. So under 20 employees, the government says it's a reasonable period of time. We would say that's probably around about 2 weeks. Obviously, that's probably quite difficult at the moment in this climate. So you could shorten that, but you wouldn't shorten it to a couple of hours. So over 20 employees, it would be 30 days. Over 100 employees, it would be 45 days. Okay, can employees pick up work emails? Well, actually, no, not really. The idea when they're furloughed is that they can't do any work whatsoever. So otherwise everyone would furlough all their employees and just let them carry on working anyway. So that's a no. Can they volunteer or undertake training? Well, actually, yes, they can. So they could volunteer elsewhere. So the actual definition of what the government says in their guidelines is that employees are not allowed to be furloughed and then provide services or do any income generating activity for the organisation. So they could volunteer somewhere else, that would be fine. What they can't do is come back and volunteer for you. So if you are a voluntary organisation, then actually you couldn't furlough all of your employees and then ask them to volunteer back. They can undertake training. They can actually undertake training for you. So if you want them to do some online training for your organisation, that's not deemed to be in the guidance of undertaking work. But you would have to make sure that if you are paying them at 80%, that you are still paying them at the national minimum wage or the national living wage whilst they're doing that training. There's in the way that you would decide who's going to be furloughed, if you have a group of people, it would be exactly the same way that you would do a redundancy selection criteria. So if you have 6 people all working in the same department and you want to furlough 3 of them, then you would do a selection criteria who on a scoring basis about who would be furloughed. You could ask for volunteers if you wanted to. That would be a fair way to do it as well. There are directors eligible. Well, the guidance doesn't say they're not, and what it does say in the guidance is that if it's a UK registered business and you are on PAYE, then you are eligible for the scheme. So the view is that potentially, yes, they probably are. What you couldn't do is be a standalone director of an organisation who is on PAYE, furlough yourself, and then continue to open the post and do work for the business, because that falls outside the parameters of the scheme. Those that are on furlough can't take holiday. You can't take holiday during a period of furlough, and there's some legitimate reasons for that. But you can bring someone back. So the minimum period for a furlough and to claim from the scheme is 3 weeks. But if you decide that you're going to furlough somebody and you say we're going to furlough you until the 31st of May when the scheme ends, and things start to pick up in a week's time, and actually you're getting orders and you can have them back at work, then actually you could just bring them back, but you wouldn't be able to claim off the scheme. If you brought them back in a month's time, you could claim the 4 weeks that they've been on the furlough for. If you bring somebody back to do a piece of work and then it all gets it gets a bit tricky again, and you could effectively furlough them again. There's nothing in the regulations or the guidance to say that you couldn't. Those on long-term sick remain on long-term sick. You don't. The job retention scheme wasn't designed so you could put your sick people on an 80% payment plan. There's keep fellow employees that call in sick. Well, no, you can't. So if they ring in sick, then they're sick. They're not effectively furloughed. But if somebody is on furlough leave, they're under no obligation to ring up and tell you that they're sick. Employees that are automatically shielded, so these are the ones, the 1.5 million that got told, told in a letter that they needed to be protected. They should be automatically furloughed regardless of the rest of the situation. So if you furloughed no one else in your organisation, you could furlough those shielded individuals. Those on maternity leave, maternity leave stays the same effectively, but if they're on additional leave and they want to come back early, they could come back and be furloughed. Those that are going on maternity leave, usual maternity arrangements are unaffected here. And then employees on unpaid leave, if an employee is on unpaid leave and you've got an arrangement in place, you would leave them on unpaid leave. You wouldn't necessarily bring them back to be furloughed, because the whole idea of being furloughed is that if business picks up again, you would bring them back. If you've got somebody who's on unpaid leave because they're on a sabbatical in Australia, they wouldn't be in a position to do that, so you wouldn't furlough them. If you're in a redundancy consultation, effectively you can furlough those employees whilst you're in a redundancy consultation. The whole idea of furlough is to try and prevent redundancies, but obviously, this continues, so there's nothing against that. And what if redundancy consultations aren't connected to the coronavirus? Well, effectively, if you're in a redundancy consultation because you were doing a restructure and the restructure started in January and the wheels are in motion, you're under no obligation to furlough those employees. You could actually confirm the redundancy as you would have done before the coronavirus. If an employee was made redundant in March, so that they were on the payroll on the 28th of February, and then you made them redundant because of the coronavirus, despite the fact that P45 had been issued, you could reinstate them, put them back on the books, and then put them on furlough on the basis that actually, as we circle out of this, the coronavirus is no longer an issue, and therefore they would be reinstated anyway. Yes, you can start redundancy consultations during a furlough period. There's some, if you're doing collective consultations, so those ones that require reps, so if you need employee reps and things like that, the consultation itself with an individual is not deemed to be providing services, but if you were to elect a rep, the guidance is unclear here, so each company would have to make their own decision as to whether or not the activity of being a rep and working on behalf of the employees and negotiating a redundancy situation with the employer is that function being a rep for the employee purpose or for the company purpose. If they're doing it for the organisational purpose, then actually you should probably unfurlough them whilst they're doing their piece as a rep. But if you deem it that actually they're providing services on behalf of the employee, you may well decide to leave them on furlough and see whether or not you could put the claim through. But again, the guidance is unclear in this, but it may become clearer in the future. Can we stay in contact with employees who are furloughed? Yes, you can. I think generally periods of layoff aren't usually in a climate where we're forcing people to self-isolate or stay at home. So in this situation where we're potentially furloughing our employees and telling them that they're going to be locked in their house for the foreseeable future, there is a well-being view here that you should be able to contact your employees and ask them if they're okay. What you shouldn't do is contact your employees and ask them to do any work. Technically, the emails should be turned off, or they shouldn't be able to access their emails, and they probably shouldn't be able to access any internal systems to allow them to communicate. But that you should be able to contact them, and they should be able to contact their colleagues as well. Okay, thank you very much.
Okay, so that was a quick trot through the furloughing rules and covering off a lot of the questions we'd had from our clients. The frustrating one is the lack of clarity on directors, amongst a few others, but hopefully those will come through shortly. When I move on to the self-employed income support scheme, I'll come back to directors there as well. So help for business. So I'm speaking from the tax perspective, and we'll go through the most common questions and discussions we've been having with our clients. Well, to start with, when the crisis was emerging, we had the budget, and the budget feels an awful long time ago, back on the 11th of March. And what the Chancellor announced was a number of measures, some relatively minor, but the really big one hidden amongst them all was the time to pay hotline, which was opened on that day. The revenue reallocated 2,000 people from their other call centres into the coronavirus time to pay hotline call centre, and they were waiting for your call to allow businesses to negotiate time to pay their taxes. And that's all taxes. When this was launched, it was intended to cover corporation tax, VAT, but we'll come on to that as there's been a later announcement for that, and the monthly PAYE. There is a very good tips guide produced by the Institute of Chartered Accountants. I've given the link there, and if you're going to ring up the time to pay hotline, I suggest that you have a read of that first, because it will help you get prepared before speaking to the revenue. Now, this line has become very popular. Talking to our clients, there was a great deal of inconsistency in treatment at the beginning, and it really depended on who you got through to. But what seems to have emerged is most of our clients were able to negotiate paying their corporation tax in smaller bite-sized installments, and some sort of deferment around the payment of the VAT. 3 months was emerging as a fairly typical period, so people who'd got in before the March PAYE payment deadline were deferring March, April and May, and entering into some sort of arrangement to bring things up to date after that. So if you want a bit of breathing space, bank loans and other sources of finance, but this is going to be the quickest and easiest to set up to defer tax payments due to the revenue. Now, I mentioned VAT is a special case. We had announced on the 20th of March, partly I think driven by the fact that the time to pay hotline was completely inundated by people asking to defer their VAT. We had an automatic deferment announced. And this automatic deferment is intended to apply to 1/4 of VAT for most businesses who pay their VAT quarterly. This automatic deferment does also apply to monthly payers, but most businesses will be paying quarterly. It's the payment that falls due between those two dates, so between the 20th of March and the 30th of June. And if you choose to not pay that payment, you've got until the 5th of April next year, the end of the tax year, to bring that payment up to date. Provided you live by those rules, there's no interest or penalties charged. We don't know what happens if you miss the payment date on the 5th of April, whether the revenue will reinstate all of the interest for the whole period. But ultimately, if you think you're going to miss that repayment date, I'd get onto the phone using the time to pay hotline and see what you can negotiate for deferred payment terms of this deferred payment. You still need to submit your VAT return. So even though this is an automatic deferment of VAT, nothing needs to be agreed with the revenue in advance. You just don't make the payment, but you will still need to submit your VAT returns. And if you have set up your VAT to be paid by direct debit, you must cancel this. This is an optional scheme, so you can still choose to pay your VAT if you want to. And if the VAT is due to be collected by direct debit and you don't cancel it, HM Revenue and Customs will just assume that you're choosing not to rely on this deferral. So that's an automatic one on VAT. Given there's no interest or penalty, it feels like a bit of a no-brainer to take the government up on that offer. The second automatic deferral relates to payments which are due under the self-assessment income tax regime. So income tax, for those who file income tax returns, the tax is generally paid in January and July each year, and if all things are equal, half the tax is paid in January, half of it's paid in July. This was originally announced as a measure for the self-employed, but it was later clarified it applies to anybody who's got a July tax payment to make. So if you've got a payment on account due on the 31st of July 2020, you can choose not to make that payment on the, effectively giving the undertaking that you'll make good and you'll pay your entire tax bill in January 2021. So you've got until the next tax payment date to bring everything up to date. As I said, it applies to everybody, not just the self-employed. So this is one thing that might benefit buy-to-let landlords, those who are still making profits. It's an automatic deferral, so you don't need to get onto the time to pay hotline to agree this. You just need to not make the payment. And if you make the payment and live by these rules, again, no penalties or interest for the late payment. So again, if you're looking to hoard your cash and hold on to a bit more money for the time being, there's no downside in relying on this, but again, it's optional. Once you've taken as much sort of credit from the taxman as you can by deferring your tax payments, you may still need to bridge the cash flow of your business. So what was also announced on the budget day on the 11th of March was the Coronavirus Business Interruption Loan, or CBILS, or CBILS as it's being referred to. This has had a very mixed response. On paper, it looks to be exactly what's needed, or certainly in the right direction. But in practice, it is difficult to get the banks to lend on acceptable terms. So let's go through the rules, and then we'll talk through some more practical things. CBILS is intended to help SMEs. SMEs are businesses with turnover of less than 45 million. There's not much clarity on whether that's applied to a single company, or if you're part of a group, the whole group, and if you're part of the group, if that group is worldwide, whether you bring in the worldwide group, and I think there might be some discretion put on the banks to decide how to apply that rule. But turnover of less than 45 million. It's overseen by the British Business Bank, but through its accredited lenders. So there are, I think, 40 plus accredited lenders, but there'll be most of the banks that you would have looking after you. So I've named a few of the more well-known ones: Barclays, HSBC, Lloyds, Metro, NatWest, are all accredited lenders. Experience from our clients so far is that there isn't much point approaching a bank that you don't have an existing relationship with. So if you currently bank with Barclays, don't go to NatWest for your CBILS loan, because NatWest will just send you back in the direction of Barclays. So start with your existing relationship. The CBILS loan scheme is guaranteed by government, but the guarantee is for the lender. So it's effectively giving the lender greater security for their loan. The government's guaranteeing 80% of the value of the loan to encourage the banks to lend, but the borrower, the UK business who's borrowing the money, is still fully liable for the debt. It's not that if they don't want to repay it, the government will step in and pay 80%, that the borrower is fully liable for the entire debt. It's just slightly de-risked for the lender. To qualify, you've got to be a UK-based business, and the borrowing must be to support this activity. You can't use one of these loans to open up your office in New York, not that that would be very easy to do right now. You have an annual turnover of less than 45 million, I've mentioned, and you've got to have a borrowing proposal which is credible. So it's got to be viable were it not for the pandemic, and you believe that you can trade out of it in the short to medium term. So this isn't just panic stations, the bank will write you a check. You have to go with a credible lending proposition. The facility is a maximum of 5 million. When it was originally announced, it was a maximum of 1.2 million, but that was rapidly increased. But the borrowing, it's emerging, the banks won't lend more than twice the annual wage bill of the company. 25% of the total turnover of the company in 2019, or an amount that you can demonstrate is to assist with the liquidity requirements of the company in the next 18 months. So even though the cap is 5 million, there are other caps that may apply which will limit your amount of borrowing. The borrowing that your normal term debt will be over a maximum of 6 years, and if this is structured as an overdraft or invoice financing, then it's for up to 3 years. One of the good features of the scheme is there's no arrangement fee, and it's interest free for the first 12 months. So effectively the government are covering the interest for the first 12 months. It's not that the interest is rolling up and will be paid later. There is no interest charged effectively to the borrowers for the first 12 months. I had heard from one of my colleagues in corporate finance that there was no early repayment charge either. That might be to be negotiated with the bank when you take out the facility. But if we've got no fees on the way in, no arrangement fee, and it's interest free for 12 months and there's no early repayment charge, apart from the hassle of going through the credit approval process, if you can get your hands on one of these loans, that feels like it might just be a good war chest that can be repaid if you don't need it later, but you need to continue that conversation with your bank. There's been lots in the media about the personal guarantees needed on these loans. So if your business is suffering financial stress and the CBILS loan is your answer, it may feel a little less attractive if you're giving a personal guarantee that will put all that you hold dear personally at risk. That's going to be a developing area, but the big 4 banks, I think actually more than 4, maybe 9 banks at the moment, have agreed that they won't seek any personal guarantees for borrowing of up to 250,000. For facilities greater than 250,000, it's likely that the lender, if they establish there's no security within the business or no adequate security in the business, they might be asking for personal guarantees, but they can't take under this scheme a personal guarantee over your family home. So you can lose everything apart from the roof over your head under this scheme, which takes some of the shine off it. It is a normal credit approval process, so typical questions which the bank are going to ask you to respond to. You'll need to be able to set out clearly how the coronavirus, COVID-19, has impacted your business. What specifically is this factor in the economy doing to your business? What are your plans for the business now and in the short to medium term? Are you going to need to change your business model fundamentally or the industry as a result of the virus? How have you arrived at the funding figure? Don't just bang in an application that's got 5 million and anticipate being negotiated down. You do need a credible lending proposition. So see if you can, with your budgets and forecasts, set out how much money you need, and expect to be able to produce some sort of cash flow forecast. I know it's incredibly uncertain, and the clients we've been speaking to about this have just been saying, well, it's near impossible. But we know what might come in from the furlough scheme. We know what your fixed overhead is, so we know what cash is flowing out the door. Try and have some low, medium, and high projections of what cash you might bring into the business. So the CBILS, on the face of it, a lot of it reads quite well. In practice, experience is showing it's difficult to get money out of the banks. And if you're borrowing more than that 250,000, difficult to borrow that money without personal guarantees. So you do need to think very carefully before embarking on that route. But with the arrangement fees and interest being covered by government, and we think the ability to negotiate early repayment without penalty, this might be viable for some businesses. I've reduced down the business rates and grants announcements to a chart because I think the way the government had presented the announcements was a little unclear. To start with, if you're not, well, actually, let's take it from the top down. Firstly, if you're occupying a business premises with a rateable value of less than £15,000, and that means that you're already eligible for small business rates relief, then you have a grant coming your way from your local authority for £10,000. There's no particular sector exclusions for that. If you're eligible for the small business rates relief, you've got this grant coming your way. Your local authority already know whether you're eligible for small business rates relief, so it's just a case of local government getting their act together and sending you the cheque. If you don't know what your rateable value is, that I've put the link on this slide where you can just put in your postcode, select your business address from the addresses that come up, and that will give you your rateable value. This is all or nothing. We've had a few clients come in and say they're at £15,500. Well, I'm afraid it's tough. The rateable value is what it is. They often bear little logic to the actual premises you're in, so it is worth checking. If you're not eligible for small business rates relief, so you're not going to get your £10,000 grant, the next set of measures are sector specific. So these apply for the leisure, hospitality and retail sector. So here we're talking about gyms and theatres and restaurants and that sort of thing. If you're not in those sectors, that's it. You can stop reading the chart from here on, because there is no help for you if you're not in those sectors and you're not within the small business rates relief scheme. If you are in those sectors, the retail discount's been doubled from 50% to 100%, so you've got no business rates for 2020, 2021. There are some businesses excluded from that. One of our clients directed me towards the guidance, and estate agents and chiropodists and vets are all excluded from this scheme for no particularly logical reason. So do try and lobby your local authority if you fall into that category. But you'll have your 100% business rates relief, and then if your rateable value of your leisure, hospitality or retail premises is less than £51,000, you'll get a grant of £25,000, again payable by your local authority. If your rateable value is greater than £51,000, you still get the 100% relief from business rates, but you don't get the grant. So hopefully that chart has reduced down pages of guidance you might otherwise have had to have read to work out what you're entitled to. So moving on, so the self-employed, we had probably only in the last week or so, the announced self-employed income support scheme. This is very similar on the face of it to the furloughing scheme. It provides a maximum grant of £2,500 from the 1st of March to the 31st of May. So £7,500 is in the pot already. And that's the amount payable is going to be the lower of 80% of trading profits, or £2,500 per month. The trading profits will be either your trading profits for 2018-19 or your average profits over the 3 years ended 2018-19. Unlike the furloughing scheme, if you choose to rely on this, or if you're entitled to rely on this, you do not need to stop working. You can carry on. In fact, it's a requirement that you carry on trading in your self-employment. The biggest failing in this scheme, well, there are a number of failings, but one of the biggest failings in this scheme is when we talk about people who are self-employed, we often think of those people who are operating through their own personal service companies. So single shareholder, same person is the director, and they provide their services through their own company. As far as I'm concerned, they're self-employed or a freelancer or whatever other term you choose to use. They are not eligible for this scheme. The only people who are eligible for this scheme are people who are self-employed in their own right and invoicing their clients in their own name and returning that as self-employed income on their tax return. It doesn't apply to landlords, so even though landlords often will operate in their own name, they are not eligible for the scheme because buy-to-let income is not self-employment income. So I'll get into some of the detail of the scheme. In order to qualify for this scheme, the individual must have submitted a 2018-19 tax return. If you haven't, if you're running a bit late, you've got until the 23rd of April to bring that up to date. If you don't bring it up to date by then, you're out of the running. You must have operated your self-employment trade in the tax year, which ends on the 5th of April 2020. And you must be continuing to trade when the application's made, or if you're not trading, that's because COVID-19 has brought your business to its knees. You must intend to continue to trade in the coming tax year, the 2020-2021 tax year, and you must have lost trading or partnership profits due to COVID-19, which hopefully would not be that difficult to demonstrate. One of the exclusions from this scheme is it only applies to individuals with trading profits of less than 50,000 and more than half of their income from self-employment. So that more than half their income test is to deal with individuals who may have an employment and a bit of self-employment on the side. And if their self-employment is the lesser part of their earnings, then they're not eligible. But the 50,000 and the more than half their income tests are applied to either the 2018-19 tax year or the average profits in the 3 years leading up to that. And you only need to satisfy one of those tests to be eligible. So if 2018-19 was a particularly good year where your profits exceeded 50,000, you can still get into this scheme on an averaging basis. Unlike the furloughing scheme, which requires employers to designate their employees as furloughed, the self-employed equivalent doesn't require anything like that because the tax authority already know who qualifies, because it's based on tax return information that's already been filed. Because they're building the scheme based on what's already been filed, it does mean that those individuals who've commenced their self-employment after the 5th of April 2019 won't qualify for this because everything is referenced back to that 2018-19 year. So the revenue will be writing to the qualifying self-employed individuals and inviting them to apply for this. Assuming you can tick all the boxes and satisfy all the conditions, you'll get your £7,500 as a single lump sum into your bank account. That is, however, taxable income. So by the time you write up your books and accounts for the year you receive that amount, if you're profitable in that year you'll be paying tax on that £7,500, but the cash flow is helpful. The cash flow, and again, another big criticism of this scheme, this money isn't going to arrive until late June, early July, and therefore you have got the next April, May, June, next 3 months to figure out how you're going to bridge the gap in the meantime. The government have not been terribly sympathetic about that. They can't move any quicker than they're already moving. They've dedicated vast amounts of resource to building the furloughing scheme, and the self-employed scheme is at the back of the queue. So they are reminding individuals that they can approach their mortgage company, and there's a 3-month deferral on mortgage payments that might help. And as a last resort, there's also universal credit, but neither of those are terribly helpful suggestions. And that's the rundown of the tax measures. I haven't covered statutory sick pay, which we might cover in a separate update, but just to try and cover the bigger measures. And at that point, I'm going to hand over to Niall, who heads up our IT team, to share some of his experience in dealing with the IT pressures and strains of the current situation.
Thanks, Tim. So I'm going to run through a few items, slightly less, I suppose, specific about current times, but as close to as we can. Some things we're going to cover in this section. We're going to discuss working from home considerations. What does it really take to be able to work from home? Technologies involved. What do people need physically to be able to work from home properly? Disaster recovery. What constitutes DR? Why you should have DR in place already, but why it's really important now, even though offices may still be open. Physically, you may have not considered some of these options that we're going to discuss. Virtual desktop infrastructure, what, why, and how it can be used to your advantage during these tricky times. Unified comms and unified comms as a service, so video calling, telephony, messaging, presenting out to internal, external people, and how to keep engaged, and what products you can use, and IT as a whole, so the team. How do you keep these guys motivated when it's probably a really very, very stressful time for us all? Yeah, okay, so let's move on. So working from home. We are massively in an unprecedented time. So working from home, I suppose we are now historically looked at a number of people working from home. So it's becoming more common in the last few years. I suppose agile working has become more common in the workplaces. And in recent years, we're now looking at an entire workforce is working from home at this current period. And I fully believe that as we're progressing and as we come out of the back end of this will really force some businesses to change their stances, and when we're back to normal, it will hopefully bring an enhanced cultural change to businesses who maybe been struggling with digital transformation. I think the real key things here are to remember that during this time, security is really key, making sure your systems are safe, making sure you have the right protection in place to maintain data security, that you're considering data loss prevention methods and tools, so that you may be allowing people to log in from home, but still maintaining, your data is and integrity is safe and not going amiss anywhere else. Limiting your operational risks effectively. Two-factor authentication systems can be really quick to put in place on securing endpoints where you may just have one point of authentication currently. I'm going to load up a few of those products at the moment that are probably the more common products out there. Some of these are really very fast to kind of be able to put in and help secure your environment. You can be looking at tools such as Intune from 365 to enable remote access to emails. Giving people the capability to work from home, I think is something that everyone's thought about, but actually the capability is not just, can you log in? What can you log into? What systems can you access? Are these seamless things to access? Is it painful to get logged in and takes hours on end to get up to the same speed every single day? So capabilities are a really important one. And that one feeds into the end user experience. How smooth is it? How many systems can they access? Are you giving people a full experience when they log in? Are they able to do 100% of their work remotely, or is it only a partial environment that you're giving? And as we talk about these different technologies, I'm a massive fan of VDI, so virtual desktop infrastructure, which I'll come on to shortly. But there's a few diagrams on the screen about some of the main leaders in that space. But the real world considerations are the right kit. If people don't have the right things to be able to work from home, if they're not comfortable in the environment they're working in, what their internet connection is like, do they have a desk sit out, are they sat on the couch? These things are really quite important for an overall experience of working from home. It's great doing it the odd day a week, but now we're moving people to working from 5 days from home. They need to be set up in the right environment. A health and safety point on that is really important to make sure they are sat comfortably, have the right headspace around them, have the right tools that they need to be able to deliver their work effectively and efficiently for you as well. So let's move on. We're going to talk about disaster recovery. Recovery, I suppose normally when we consider disaster recovery from a traditional point of view, we look at the four main areas, which are technology failure, disaster recovery, human error, natural disasters, human error, security, and national and international events, which are now more common and may not have effectively been a part of everyone's traditional DR strategy. Technology failure, can constitute a DR scenario such as, loss of hardware if you're on premise, loss of an office, power spikes causing things to blow out, hard disk failures. There's a whole range of things that could go into a technology failure. At the moment, I think one thing that really hit us was we have an effective DR plan, but I suppose something we haven't thought about is in a lockdown type scenario during this period that even not having access to your on-premise kit will be considered an operational risk that you may need to invoke. If your hardware died and you physically aren't allowed to go to the office to replace your kit, then you definitely need to consider moving to a DR mode. Security from a disaster recovery point of view is another more common reason to invoke DR nowadays. So malware and cryptoviruses are now a common theme for having to invoke DR. It's important to ensure you're using the right disaster recovery technologies to make sure that you're compensating for those. So, a limited DR replication during a day, so that if you hit a malware piece or a crypto locker piece where it's locking up your files, you go back and restore that and wipe it out from the environment very, very quickly. So human error, unsurprisingly, cutting through a cable, an internal cable in the comms room, an external cable outside from a telephony point of view. Your comms lines in and out of the building are vitally important to businesses where internet connectivity is now key to all successful businesses. Software update going wrong, IT guys at the weekend doing an update could cause some major issues if it goes wrong and isn't tested out well. All these things can lead to having to pull in the DR scenario. So it's always really important to have high availability in your environment. So making sure that you maintain operational levels without causing a business risk. So where you can split services across multiple boxes. So for instance, email exchange on premise, one exchange box could go down, having it stored somewhere else in another location or another host as a replica if one was to fail is going to be real key to a successful environment. And likewise for on-premise versus cloud. The cloud doesn't necessarily secure you from a DR environment. Some businesses are still entirely on-prem. They may use some element of cloud for different offerings and different levels, but it's really important to maintain that cloud offering can take away risks because you're passing that risk on to a provider in multiple data centers across potentially multiple countries, definitely across multiple locations. But it can add a huge complexity around security, compliance, and capacity. Just for instance, over the last couple of weeks since we've hit this level of unprecedented working from home and businesses altering the way that they work, some of the EU's largest cloud providers have seen a huge spike in usage, and which enforced them to place capacity limits and usage limits on their clouds, which we've never ever seen before. So new server creations were at an absolutely limited number for every client for a set amount of days. So it's important to make sure you already have that capacity ready and waiting available in your environment, be it on-premise or external from a cloud perspective, to make sure you have capacity if you were to hit DR. So DR isn't, like I say, cloud is a great way to run your DR. Off-premise is a great way to be. On-premise, again, is a great way to be. But with that, the likes of Azure, for instance, I've seen multiple instances this year where they've left users without access to different systems in place, and allowing clients unable to invoke DR. So a hybrid approach is going to be really, really important. I think it's going to become much more commonplace in the next few years. So from a disaster recovery point of view, if you're on premise, consider put some of your DR point to external parties or cloud. If you're all cloud, consider having a backup cloud or a DR site somewhere else with on-premise kit. I think is going to be a real key. Just while we're on DR, so DR solutions. I'll bring up a few we have in a moment. DR solutions can be really quick to put in place. They're not necessarily a 6 to 12 month project. I think picking the right technology stack for your environment is going to be really important. So products such as Zerto, Veeam, or Druva, all software based, you can all be up and running with a very competent, very secure, compliant DR base within a couple of weeks if you get to that point. And I think that the main secret to an amazing DR recovery plan is to plan it, test it, and repeat. So you will never know how good your DR plan is until you test it. So it's important to revisit every 3 months, 6 months, do a full sweeping test, make sure that all your environment can cope with whatever was to before you. So do full scale tests, get people from the business involved so they feel confident if you were to hit a DR scenario, you'll be able to cope. I think an always forgotten element, telephony, is a key one for DR. So you may be able to work. Can you communicate effectively? Can you access all the contact information for everyone you need in the business? And while we'll talk about it a little later on, and unified comms solutions, unified comms can be a really painless way to give you disaster recovery for your telephony suite as well. So we'll move on. Virtual desktop infrastructure. I again, massive fan of VDIs. VDI is virtual desktop environment, which allows you to log in from home, from anywhere in the world, giving you the same seamless experience that you would do if you were sat in the office in front of a PC. So traditionally, two flavors of VDI, traditional VDI or multi-tenant VDI. Traditional is a dedicated virtual machine for each user with every bit of software they could ever need to use installed on, ready there and sat and waiting for them every single day when they log into the system. Multi-tenant is a single machine which is shared across multiple users. So very large virtual boxes, 10, 15 people logging in at the same time and accessing the software that is on that box, obviously, set up in the right manner. Either of those are neither right nor wrong. It all depends on how you want to run your environment, how you want to manage it. A VDR environment gives your users access to all the software, systems, and tools they could need to do their job. So no matter what device they're logging in from, a laptop, desktop, tablet, what location, whether it's in the office, from home, overseas, wherever you have an internet connection, you'll be able to get the exact same single user experience across all devices. Being able to scale up and scale down is really important. So for us, for instance, last week, knowing that actually a couple of weeks ago, knowing that we were going to be able to we were going to hit a point where we're going to have maybe 50, 60 more people on the system than we normally would do on an average day, meant that we could scale up really very, very quickly because we had capacity there to do that. So for businesses that run maybe a small VDI, making sure that you have the capacity that when you hit the scenario or if you want to start to scale up now, making sure you have capacity to do those things and you have the right tools in place. With the right tools, you can go from 10 machines to 100 machines in 10 minutes, as long as the environment is obviously set up properly and provide you have capacity and infrastructure to cope with that. Again, huge benefits: single environment, one desktop for all users, meaning you give the same consistent experience in or out the office. If you need to fix a bug, update a piece of software, then you do this once. You do this in the golden image. The next time a user log in, it's available to all, taking the pain out of rolling out updates to hundreds of laptops and desktops across multiple locations, especially in this environment where people are working from locations where you have no touch points from an IT point of view. They're working from home. You won't be able to get those updates and those software updates out to those people as quickly or as easily as you would do with a VDI environment, or if they were in the office. Major players in this space. So traditionally, they were all on premise. So you have to have all this kit on site to be able to run a VDI environment. They now traverse on-premise and cloud infrastructure, so all the main providers in this technology place now offer desktops in the cloud as well as your own hardware, and they also allow you to integrate your on-premise VDI to be able to burst out to their cloud, obviously depending on your setup. Most recently, Microsoft joined with a fixed price desktop, which gives you in Office 365 integrations, standard software stack for a fixed price back in November 2019. So while it's not as fully featured as the likes of Citrix, who've been around for a very long time, have been the leaders in that area, and they continue to lead this path. There are plenty of providers who are willing at the moment, like especially at the moment, they're all clamoring to get more people on board, show that their environments work and can support working from home during this time. So now is a really good time to, if you've got some capacity in your IT department, run a proof of concept, see which environments or which software stacks will work best for you. They're offering price breaks. So Citrix are offering something like 52% off their current licensing if you were to take, I think it's by the end of April. So there's a whole host of negotiation tactics you can use in the moment and proof of concepts during this point to kind of either see you through a difficult period or to prove a point if you've got capacity to show that this technology works for you. And it's a great time to do it if you've got the ability to do it now. So Unified Comms and Unified Comms as a service. Traditionally, Unified Comms is referred to as an on-premise solution, normally entailing hardware phone systems at each office or each site. Maybe you have an app for your phone where you can divert your desk number to. Unified Comms as a service is a fully hosted solution. You don't manage any hardware apart from having desk phones in your offices if you so wish to. These technologies nowadays, Unified Comms as a service, come wrapped in a consumer app type experience. So Zoom, Teams, Fuse, Hangouts, RingCentral, Skype, you load up the app, it's as if you're using all very, very straightforward. Not a huge amount of training involved to be able to make a call or do a video call. So these things are seeing massive bursts of people have taken these recently. Teams and Zoom, hundreds of % increase in user sign-ups and usage over the last couple of weeks, inevitably from everybody working from home. These tools, I think, are going to massively change how, when we all go back to normal, how we communicate in the office. More video, I think, will become the norm. Instant messaging, we personally as a business have seen a massive increase in instant messaging and video calling, something like 2,500% increase in video calling compared to what we were doing 3 weeks ago. And the fact that these platforms are able to scale up because they are hosted in the cloud and be able to scale up and meet that demand has been a real testament to this technology stack. For us, we are a Fuse house. We've used it for the last couple of years. It's been massively invaluable, like I said, during this period. We rolled out video across the board. Everyone's taken to it really well. I think as we come out of this side, we're going to see a lot of the traditional, Avayas, Mitel, the old house kind of Polycom community comms providers really either struggling to keep up, or they're going to see a lot of customers move to the likes of Zoom and Teams and Fuse and Hangouts because they're just so simple, very quick to set up. Zoom, you can go on the site and you can sign up, as many users as you want within a few clicks. You can integrate it with your single sign-on provider. You can integrate it with your desktop, app on the phone. It's very, very easy to get it set up, especially during these times. Very easy to start doing meetings with clients so you can keep your business running. Very easy for your internal departments to keep in touch, and face-to-face is really important during this time for a social isolation point of view. So yeah, again, I think these are going to be really invaluable as we move through it, and the back end of this I think it's just going to keep growing. And I'm going to move on to my last point, which is the IT department. Just a note to, my department has been working really hard around the clock. I'm sure everyone else's IT departments have been doing the same thing. I think it's really important to understand that, those guys are going to be incredibly stressed at this point. I think we're into hopefully business as usual for most business now. If you're not, hopefully it's coming around soon for you. I think the IT teams feel a real pressure. Normally day to day, you're making sure that everyone can work effectively and they've got the tools they need. But now, especially, I wouldn't underestimate the extra effort that everyone's putting in to keep these things afloat and keeping these things going for you every single day. I think it's really remember that that department's in the same boat as you guys. They have their own families, they have concerns, outside of work, and they're still working hard to ensure that that businesses are running effectively and as well as they can. I think just from my own experience, I think you goes a huge amount of way with IT departments. If you feel they're doing a good job, a really easy way to keep them feeling sharp and motivated is just to say a quick thanks. It's not often that it's more common that the IT department hears when things are going bad, but if things are going really well, pop them a thanks, and I think that'll really spark them to kind of carry on pushing forward and keeping everything afloat and keeping them motivated. I think is a real important one. I suppose you're relying more heavily on this department than you normally necessarily would do day to day. So yeah, brilliant. And I suppose as we come to the end, if you've got any questions, the email address is on the screen. You can pop Kirsten an email and she'll pass them on to us and we'll come back to you. So yeah, thanks for your